Hi, it's Eric Nuttall of the Ninepoint Energy Fund. I'm happy to join the MindPath conference to chat with you about why I believe oil is in a multi-year bull market, why effectively we're going to see all-time high oil prices in the years to come. And then I'm going to discuss the opportunity that I see in energy stocks today. It'd be very, very easy to think that given the strong run that we've seen in the sector year to date, that the party's over and that valuations are full, et cetera. And I'm going to walk you through why I feel there's still very meaningful upside, not just in the weeks ahead and the months to come, but really in the years to come. I believe that the multi-year bull market for oil will last at least 5 to 6 years, and there could be extra longevity to that. And I'll walk you through my logic in terms of why that is. And so the crux of my thesis revolves around two factors. One being on demand, is that demand is normalizing from the COVID shock that we had last year. So much of last year was revolving around people talking about new normals. We were locked in our house. We knew nobody was going to ever fly again and drive again, working from home, etc. And if you fast forward to today, we're essentially almost back to pre-COVID levels, with the one exception being jet fuel, as you can imagine, where it's too much of a nuisance to take your family on trips when you've got a quarantine for 14 days with young kids who still are not vaccinated, etc. And yet, as we move from a pandemic to an endemic psychology worldwide, and as government restrictions get removed, I think it's pretty fair to say that we're all going to want to go on trips and et cetera, and business travel will resume. And so that last element of weak global demand being jet fuel will reach normal levels, and hence we think that we'll be back to pre-COVID levels by about the middle of next year. After that, I think we're going to grow on a net basis, being global oil demand, for about another decade. I've got more slides later on to explain why I believe that to be. And yet the main story revolves around supply. The main impact of COVID is not going to be on demand long-term, and it's really going to be on accelerating certain underlying trends of structural tightness on the supply. And I'll walk through why we're in a post-US shale hyper-growth world, meaning US shale growth rates can no longer satisfy demand growth. I'm going to walk you through why I believe OPEC will be exhausting its spare capacity within the next year. And then I'm going to walk through why the global super majors, who haven't been sufficiently investing for 7 years now, will continue on that trend. And the net result is what you're seeing on this screen. This is global oil inventories using the IEA as my data reference. And this is admittedly about 2-month-old data. I've got real time coming up in the next slide. But this is what shapes consensus, because everyone, largely, most people rely on the IEA for the modeling. Most Wall Street models use the OECD inventories that the IEA provides. And so what does that tell us? What we see is the massive increase in oil inventories that caused last year from the demand shock from COVID, as we were not flying, not driving, et cetera, has not only been completely eliminated, but now the oil market is in a significant deficit, not to last year, but to the trailing average excluding 2020. We really, for analysis purposes, have to exclude 2020 because it distorts what is normal, obviously. And so when you compare it to the trailing 2015 to 2019 average, global or OECD inventories are at a 155 million barrel deficit relative to that time period. And importantly, this trend continues. And so what this shows is the impact of COVID on the net inventory picture has been eliminated. And so why do I follow inventories as closely as I do? The challenge with the oil and gas sector is getting good data is tricky. Getting real-time demand data is tricky. Getting real-time supply data outside of Canada and the United States is challenging. And yet when we look at, okay, has the greatest historical relationship to the oil price, it's oil inventories, because that is the nexus between supply and demand. If demand exceeds supply, inventories fall, just like they've been doing this year. And like last year, when supply is in excess of demand, inventories rise. And there's an incredibly strong inverse correlation between oil price and inventory trajectory. It's my compass really that helps me guide my unit holders through what was an epically challenging, epically volatile, epically confusing period of time to be managing an energy fund, which I've been doing for about 12 or 13 years. More importantly, I'm a huge believer in getting the best quality data that I can. And so for the Ninepoint Energy Fund, we subscribe to a firm called Kepler. This is using satellite imagery, so satellites that look down and analyze every vessel in the world carrying crude oil and every tanker in the world that has crude oil in real time. And then it uses artificial intelligence to track what our global inventory is doing, not on a 2-month-old basis, but on a 1-week lag basis. And so it's much more valuable information. And so what does that very valuable and expensive data tell us? It tells us that coming into this year, from a global perspective, not just OECD, the world had about 225 million barrels of excess inventory relative to 2017 to 2019. Fast forward to today, and that's been almost completely eliminated, and that should be occurring in the next couple of weeks. And so global oil inventories, just again to reaffirm the health of the energy market, to try to support, okay, why are we at $85 spot price right now? It's largely completely justified by what inventories have been doing. So we're set to end this year at a multi-year low. That's also expressed in US inventory levels. This is more what the mainstream generalist guy gets. You're watching CNBC and Wednesday at 10:30 comes out, oil inventories up or down, and then oil trades off of that for a short period of time. And what that data shows us is that for not just for crude oil on the left, but also crude, gas, and distillates, inventory trajectory continues to get healthier with each passing week. And so why is this occurring? I touched on earlier, yes, demand is a big part of the picture. Demand's been normalizing faster than I think what almost anybody thought. Most people, especially there's still people hanging on to their uber bearish sentiment and thinking, well, the 5th wave, 6th wave, 7th wave, etc. It really feels like the elasticity of demand in the short term relative to what's happening on COVID has broken down. It's not nearly as strong. And going forward, I expect that to remain the case. And so with demand normalizing, the real story has been on supply. What we have seen, and the largest impact is OPEC, which I'll be touching on in a few slides from now. But the biggest shock has been to most is what's been happening in US shale companies. For the past 10 years, US shale has been a hugely destabilizing factor in the energy markets, because here we had this new source of massive supply growth that had a short cycle. You drill a well, comes on in 4 to 6 months. And we had these shale executives telling us, well, geez, our break evens are $25, $30. And it really perverted the market sense of a couple of things. One, what is a fair price for oil? Why would we ever trade at 100 if these guys are saying they're profitable down to 25? And also the depth of inventory. They would tell us, well, geez, Eric, we've got 30, 40, 50 years of this wonderful resource. So you're like, okay, low cost, long nature, like oil is in trouble. And you saw an exodus of investors. You saw companies grow oil production meaningfully. It led to a couple price crashes. It led to massive pivots and infighting within OPEC and scorched earth policies and all of these really, really nasty things to have to deal with. Today, I believe we're in a post-US shale hypergrowth world. And so what does that mean? You have to acknowledge, okay, what's been happening the past couple of years? And namely, the energy sector has been a really challenging place to have been invested. And so it led to a turnover in shareholder bases from growth investors to value. The growth guys went and they bought Tesla, stocks imploded. They fell in many cases 70, 80, 90%, entered the value investor. And so for the past 2 odd years, value investors have been having a conversation with shale CEOs, and they've been saying, okay, look, we cannot repeat the sins of the past. This focus on chasing production growth has only led to oil crashes. The only benefactors or beneficiaries been the global consumer of getting a barrel of oil cheaper than what they should have been. What you need is to change your ways. We need to abandon growth or meaningful growth, modest, we're talking 2, 3, 4%, and really focus on maximizing free cash flow to allow for return of capital back to shareholders, because we all need to get paid. It's been misery for a very, very, very long time. This is our time to get paid, and we get paid through share buybacks. We get paid through base dividends. We get paid by variable dividends. And it took a good 2 years, but those investors were successful in changing the US shale business model. And so they are now just beginning to get variable dividends on a quarterly basis, which at current oil pricing is going to approach 14 to 16% returns. So that's pretty juicy. And so I've coined a line that is like discipline, spending discipline is the new normal, because what is the ability of a shale CEO today to go to those shareholders and say, look, we know you're getting this 14, 16% dividend, but we want that money back. And we want the money back so that we can go drill and chase production, because we know how wonderfully that turned out the last time. And so this necessity to return capital has been codified. It's been enshrined. And I think any CEO that dared change that would be fired. And at the same time, why did US shale grow as much as it did? Was it that the geology was so wonderful? Was it that their break-evens truly were so low? We know that is not the case. It was shale companies' ability to access external financing. Over the past couple of years of hypergrowth, when growth from US shale exceeded demand growth, it was because companies were spending about 1.5 times their annual cash flow. So you generate 100 million of cash flow, you spend 150. And so that 50 million of excess spend had to come from the stock market, banks, or the high yield market. In today's atmosphere, the equity markets are closed. Banks want out. Every week, with COP24 or whatever, we've got more and more headlines of banks signing on, lowering their emissions, from their loan book, demanding change, et cetera. Banks want out of this business in both north and south of the border. And high yield market, you're looking at 9 to 12%. Kind of difficult to go borrow money at that rate and then go drill, and grow your production somehow with that. And so the ability of these companies to outspend their cash flow is no more. And so even if the CEO wanted to take that dividend away from the investor, their ability to spend what they did in prior years and achieve the growth rates that they did is no more. And so, yes, what we're seeing is some private US companies are increasing. They're about 60% of the rig count. A conversation to be had there is their inventory depth is not nearly what it was. They're financed by PE firms where all of those funds are nearing the end of their natural life cycle. And so the PE funds have to monetize to return the cash. And so these companies are drilling up their locations to get lending value, get production up, and then be able to sell an asset that's effectively in blowdown mode. And so we're talking, we're probably looking at 500,000 barrels per day of growth from them next year. And then that's a flash in the pan. That gets more than halved in 2023 and going forward in the context of probably 1.2 to 1.5 million barrels per day per year of demand growth. And so the loss of US shale hypergrowth, and the reason why I've spent so much time on this is a major watershed event for the energy sector, because the road that we've been on as energy investors for so long is it's been really bloody bumpy. And those bumps were potholes, which were US shale. Anytime there was a rally in the oil price, here you had a surge of US shale production 4 to 6 months later, and it killed the rally. We had to ride that roller coaster a couple times. On the road forward, without those speed bumps, potholes, US shale, the road is much smoother and the visibility is much better because we're going from short cycle production, 4 to 6 months, to long cycle production, 4 to 6 years. And that's a major, major change. Were it not for US shale production growth over the past decade, non-OPEC production would have been flat while demand had grown by 6 million barrels per day. That is how important US shale hypergrowth has been to stabilizing the market. We already would have been in energy crisis were it not for US shale, and that's where we're heading into. And so when we look at other factors, the need to underspend, the likely sterilization of resource we have on the right hand. This is a article from about a year ago from one of the largest PE funds in the US, one of the biggest drillers, talking about how the dirty secret about shale is these companies really downspace too much, meaning they messed up the reservoir by drilling too many wells close together, and they've effectively sterilized that resource. We don't even need to buy into any of this. It's getting too far into the weeds. Just know the financial model has changed, I believe, forever, and the need to satisfy variable dividends is a massive, massive change, and it means that discipline is the new normal. And so without the loss of US shale hypergrowth, there's a natural deficit in the market that needs to be made up. Otherwise, inventories keep falling, and that puts meaningful upward pressure on the oil price. And so where are those barrels going to come from? Well, they must come from the remaining players, OPEC and the global super majors. When we look at OPEC, think about what they've had to deal with for the past 6, 7, 8 years of suboptimal oil prices. And when I say suboptimal, I mean oil being below their fiscal break-evens. If you're a petro state and 60, 70, 80% of your revenue comes from oil sales, well, then oil has to account for 60, 70, 80% of your state expenses. And in many of these countries, you have a social contract with your population where you will subsidize power, you will offer well-paying government jobs, you will offer free education all around the world, et cetera. And the flip side to that is the social contract is don't go out into the streets and revolt and demand regime change, because we've seen what happens to leaders in countries like that, like in Libya. And so in an era of low oil prices where your revenue is imploding and your expenses cannot, What were these countries spending on? The easiest thing was new oil productive capacity, because you spend money today, you're getting zero revenue for 4 to 6 years. That's how long it takes to build the capacity. And you've had to satisfy those social expenses. And so what we see largely within OPEC is, yes, they've curtailed production meaningfully, as much as 8 million barrels per day for a short period of time. That helps stabilize the oil market. Today, they're likely sitting on about 3.5 to 3.9 million barrels per day. So this is pre them adding barrels onto the market in September. We know the deal is to add 400,000 barrels per day per month, so long as market conditions allow. And so you can do the math, 4 million divided by 400,000, that's 10 months from now. In 10 months from now, I believe OPEC is out of spare capacity. And what happens then? So this was the natural shock absorber for any geopolitical event, any demand exceeding supply unexpectedly, et cetera. They've always had those barrels. And so as much as it was a watershed event for the loss of US shale hypergrowth this year, an even more bullish catalyst next year is this theme. This is starting to become on front page headlines, and it will only grow in influence next year. And so what gives us more confidence that this is occurring? Already there are countries underproducing their quota, and Nigeria is a great example. So they're currently underproducing by about 200,000 barrels per day. That doesn't sound like a lot. Well, that's like 350 million of lost revenue per month that they're willingly giving up. And so like, who in their right mind would do that? Clearly, the inability to invest in productive capacity means that they can't reach their quota, let alone where they could produce now, but the future quota. We say, well, there's 4 million barrels per day that they've taken off. So the great thing with the oil and gas business is it's massively capital intensive. If you don't spend money, you just don't stay flat. Your production falls. And so these countries, largely, we think there's a meaningful catalyst next year is, it's kind of the emperor has no clothes. Here, okay, well, raise your production, here's your quota, and multiple countries will be unable to do so. And so the last kind of what's been the elephant in the room throughout much of this year was Iran. It was a concern, oh my God, what happens when the JCPOA, that Biden really wants a deal, there are all of these barrels shut in, and it's going to swamp the market. And, the bears always need something to run with, and this was it. And so it was a surprise that, the nuclear deal the negotiations have fallen apart. Hardliner of a new regime in Iran, hardliner who's against the deal becomes the lead negotiator, et cetera. Will this come to fruition at some point in 2022? Who knows? If it does, what's the real impact? Official productive capacity, we're looking at about 1.3 million barrels per day. At the same time, you can use satellites, you can see ship-to-ship oil transfers, you can see smuggling, you can see inventories rising in China, and you can't really account for where that oil is coming from. And so if you account for the smuggling that is going on in real time, that everybody knows about, the real number is probably about 700,000 barrels per day, give or take, in the context of, again, demand growth of 1.2 to 1.5 million barrels per day per year. So roughly 6 months of total demand growth coming from the only remaining source of low-hanging fruit. It was common for a couple of days anyway, stuff to talk about Venezuela. Jim Cramer, on CNBC, Mad Money saying, oh my God, Venezuela, it's gonna be huge. They've got all this production, all these barrels, and it's gonna be the next big major bearish catalyst. And if you take a moment to reflect on that, you're like, okay, we're in an era of companies no longer willing to invest. So, okay, you need somebody to willingly go into Venezuela. Two, what's happening the past couple of years, it's been a human crisis where, you had women leaving into Colombia this couple of years ago to shave their heads for wig manufacturing for $25 US, which would feed their family if you could find, food on the shelves. So there's been a massive exodus, massive brain drain. You can imagine what's happened subsurface in heavy oil deposits with virtually no spending going on. Above surface, imagine the pillaging, looting, etc. And so even if you found willing investors, even if you found the people, it would only take $58 billion to restore, lost production. And so, if the stars aligned and whatnot, Venezuela was one of the most affluent countries in the world at one point. It's amazing to think about. We're talking several years, at which point the world's already entered into an energy crisis. And so the last bullish thesis that I have revolves around the global supermajors. And so this is about 40% of global production. We know that spending peaked around 2013, 2014. It's been on a downward trajectory ever since. Why? Because the oil price crashed. You go from 100 to 30 negative. Clearly, spending has to drop. Cash flows implode, and so companies have not been sanctioning enough projects recently in a recent history to offset a global base decline rate, which offshore is about 10%. Generally speaking, it's 4 to 6% roughly. So again, you need to spend money not to stay flat. You're going to fall if you don't. And so all of the large projects sanctioned back in an era of $100 oil have come online. The last one, the major one, is Johan Sverdrup in Norway. We've got some small projects coming on in Guyana. But again, from a holistic approach, global production from these countries are flatlining to declining. And so what is new today? ESG investing, right? We hear about it every day. It's having massive impacts on capital flows, the willingness to invest in dirty oil, et cetera. The spending behaviors on boards going forward, where many in the epicenter of eco-wokeness in Europe, the Royal Dutch Shells, the BPs, they're not keeping production flat. They're allowing their production to fall in order to free up capital to invest in renewables, global offshore wind and solar, et cetera, which we know are horrific businesses in many cases. You've got the Vesta guiding for negative margins this year, as they're fully exposed to increasing in raw materials. Many of these projects require government funding, et cetera. And yet, the biggest factor, I think, is uncertainty about what the future demand for oil looks like. And I have a line that I've coined, and that is, the fear of peak demand is leading to the reality of peak supply. The uncertainty about what the demand picture looks like 10 years, 15, 20 years from now, what the price environment looks like, is preventing investment today, which is having an immediate impact on supply today. And it's one of the key reasons why the world is hurtling into an energy crisis. I wrote an article I do a biweekly column for the Financial Post, and I wrote one 10 columns ago, I think, well before what was happening in Europe. And the theme was, as you just have to connect the dots and look through the variables that we're looking at, the world is very, very clearly hurtling into an energy crisis because of this factor. Another that I coin energy ignorance, which is the lack of knowledge of how critical oil is to our daily lives, and more importantly, the likely time frame to displace oil, which I'll touch on in a few slides from now. And so the underinvestment by the global super majors has been going on for 7 years. So you don't quickly change a long-term trend. And even if, what would allow the CEO of Royal Dutch Shell, the CEO of BP, to pivot away from this theme where they've just been spending billions of dollars, and they'll spend billions and billions and billions of dollars more, to say, we really goofed. Here we're at 85. I think we're going to be at all-time high oil prices in the next couple of years for all of these reasons. Okay, we goofed. We need to start spending because, offshore wind and such, it's going to take 20 years to reach critical scale. It's too late because of cycle time. These companies don't drill wells, they drill projects. And again, it takes roughly 4 to 6 years and costs billions of dollars per to bring on a drop of oil. And so this is 40% of global oil supply represented in some of these countries and others. And when you aggregate their production, given 7 years already of insufficient investment, and that's only getting worse because of ESG pressures, we're looking at flat production growth for at least the next 8 years. And so when you combine that all, plus you look at the demonization of the oil and gas sector, where you've got the AOCs wanting to throw oil CEOs in jail for lying about climate change, and I think secretly knowing they're destroying our planet. And then on the left-hand side, you've got gentlemen like this swearing at somebody on live television because he dared recommend an oil company, and therefore he's supporting the destruction of our world. Given this level of animosity towards a oil and gas sector, especially in Canada, one that supplies a barrel of oil in certainly the most ethical manner, and in one of the cleanest manners. We're the only country in the world that held up the construction of a major pipeline project for 2 months on account of the migratory pattern of the common hummingbird. And so how could anybody say that in Canada we don't respect the environment, where our producers have pledged net zero by 2050, which accounts for 98% of all of the oil sand production, et cetera. So I'll get to that later on, steal my own thunder. So the common theme here is ESG pressures, the demonization of our sector. All of these things are only accentuating a trend that's been 7 years in the making, which is leading to a supply crisis. The challenge with that is, I believe that all of you watching this webcast will be using oil for the rest of your and my lifetimes. And okay, so why is that? Because we hear about, the greening and decarbonization, and we're heading there, and got well-intentioned government policy, et cetera. And so one of the reasons why I'm writing this column for the Financial Post is to try to improve what I call energy ignorance again. The lack of knowledge of how critical hydrocarbons, oil, is to our lifestyles, and at the same time, the likely time frame to replace it with an alternative, whether it's hydrogen or electric cars, renewable jet fuel, et cetera. And so let's talk about how is oil used and what are the competitive threats. We'll pretend we're in MBA school here, and we'll do a SWOT analysis. So oil, we're almost back to 102 million barrels of the stuff consumed every single day. 60% is for transportation, 40% is non. And so let's deal with the 60%. Roughly half of that, so the 27% of global oil demand, is used for light passenger cars. And so we know that none of us are going to be driving an internal combustion engine in the years ahead. The government of Canada has pledged all new sales as of 2035, as have other jurisdictions. We've seen California, we've seen the UK, and so we're all driving. Okay, fine. There's 1.3 billion internal combustion engines on this planet today, and EV sales last year were 5 million. And so yes, that 5 million is going to ramp, and it's going to ramp quickly. But how many years, how many decades does it take for new sales to offset not only the base, but that base is growing? The CEO of AutoNation, largest car retailer in the US, was on an interview in CNBC last week. And he said, look, the mistake people are making here is, yes, the average life of a car today is 12, 13 years, but the average useful life that people, largely invest in a car, not those who, do 3-year leases, et cetera, but the more average consumer who's buying a car, it's like a 20-year purchase. And so you've got a 20-year investment that you've just made. And so even if the government forces, EV sales 2, 3, 4 odd years from now, you've got an install base that you have to displace. So that does take time. And at the same time, what are challenges? What are guardrails to adoption rates? Because a common phrase now, which drives me nuts, is, well, high oil prices are going to accelerate the transition. That is complete BS, because there are natural gating factors on speed of adoption that you just have to logically think about. The government's ability to fund, the government's ability to build out, super fast charging stations, the ability to increase the global transmission grid line and power generation, where Elon Musk said, if we're all driving electric cars in the US, we have to double our power generative capabilities, 100%. And at the same time, the Biden administration wants to completely decarbonize power generation in the United States by 2035. So how do you double what you already have, but at the same time, you have to decarbonize what you already have in the next 13 years? Mildly challenging. How do you get around constraints such as the lack of raw materials like copper? RBC did a great study, and they said, and this is old, this is before more governments got a little more aggressive, and they said, if we try to achieve government goals of electric car sales, there can be a 32% deficit globally in copper production by 2030, not that long away, in an environment where copper manufacturers aren't really ramping production all that aggressively. So there's well-intentioned government policy that you could hear about every day. And then there's our energy reality. And there is a chasm between those two things. And eventually those two things have to bridge. Road freight, 20% of global oil demand. Well, this is not batteries, this can be hydrogen. And so I had to subject myself to 5 odd hydrogen conferences the past year to make sure I wasn't missing anything. And I could have just fast forwarded to the final 5 minutes to the conclusion. The conclusion is, even if companies want to invest in this, it's going to be 2040 before that reaches critical scale. So we've got, more than 15 years to go here, and yet no one's spending, and production is going to flatline. So every single competing threat that we have for oil, the displacement timeframe is measured in decades. So that's 60% of global oil demand. Let's talk about the 40 where there is no substitution. Things like, petrochemicals, lubricants, plastics, makeup, medicine, the other 2,000 things that require oil for. Well, that's 40% of global oil demand. And the drivers of growth there are population growth and living standards. And so when we look at, the world's going to be growing by 2 billion people between now and 2050, when we have to reach net zero status, And yet those people, the population growth, that's not in Canada, it's not in the US, it's not in Japan. It's in areas of the world where they yearn to have our massively energy intensive lifestyle. And so are we going to tell them, no, you can't prosper. You've got to cut your hydrocarbons, and you have to build solar farms, and you've got to reach net zero and such. And you can see the animosity between the energy haves and have-nots right now. Their priority is energy affordability and energy reliability. And so I'm confident that when we look at the lack of elasticity of demand to rising oil prices as the global economy goes from less manufacturing to more service, and when we try to model out, okay, what's reasonable? This is the best scenario that I've seen, and it's from Sanford Bernstein that does really, really great macro work. So they modeled it out and they said, okay, let's assume we hit every single government objective when it comes to electric car sales, which is that red dashed line on the left. Let's assume that hydrogen gets built out, on the right, that blue hash. And so what's the punchline? The punchline is that oil demand continues to grow between now and roughly 2035. We know this is going to be wrong. There's like a trillion different variables to model out, but it's reasonable. And so we have 13 odd years of demand growth. And more importantly is what happens the next day? You ask the average guy, okay, oil demand peaks. What happens the next day? They say, well, we're not consuming oil anymore. It implodes. No, it's a very slow decline because the pace of moderating demand from substitution, it takes time to work through, the bases of the internal combustion engines to displace, heavy hauling trucks and ships and planes and plastics and plastic straws and petrochemicals and, electric cars drive on tires made from rubber and all of these different things. And so I posit the question, and this will blow some of your minds, I think, but what happens to the oil price when we reach peak oil demand? Most of you will probably naturally think, well, the oil price goes down, right? Demand goes down and price goes down. My scenario, my belief is the oil price actually continues to rise. You may be like, okay, look, Eric, what are you talking about? People forget that price is determined by two things. One is demand, but the other is supply. And I would ask you the question, if companies are unwilling to invest today in new productive capacity, given the uncertainty of what the world looks like 10, 15 years from now, what will be their willingness to invest, especially when resource prospectivity and stuff we've chewed through US shale, we're chewing through most known discoveries. What will be their willingness to invest then when oil demand is actually falling? And so my own belief is we reach peak oil demand and the oil price keeps going up, and that will blow people's minds. And it has a very, very important implication on the terminal value of companies with long resources, i.e. Canadian oil sands. And so when we look at some other factors, I've mentioned here's the graph that I referenced earlier by RBC, 32% deficit on copper by 2030 if we hit government things. Musk saying we have to double the power transmission capabilities in the entire United States just to hit goals. So population growth, we've mentioned 2 billion from 2019 to 2050. These are UN numbers. These aren't, Eric Nuttall numbers. So you've got 2 billion more souls coming onto this planet in areas of the country where their living standards is now inflecting and where their energy intensity of that lifestyle is meaningfully going up. And so we need alternatives. We need every wind farm we can possibly build. We need every solar farm we can possibly build. We need oil production growth. We need natural gas production growth. We need coal, frankly. And what we really need is nuclear, but there's such a psyche challenge with that, after Chernobyl on Netflix and such. I don't know if there's a government buy-in for nuclear, even though it's the biggest no-brainer of all time if you truly want to reach net zero status. And so how do you make money from this view? I run the Ninepoint Energy Fund. I've been doing that for 12 or 13 odd years. It's been through the worst bear market in history. And despite that, our performance on a relative and absolute, especially in recent times, it has been pretty good. My focus is purely on Canada now, not because I live in Toronto and I travel to Calgary and I'm Canadian and such. It's because I believe that is where the very best opportunity for energy investors is on this planet. Why? Because the reasons why energy investors fled our jurisdiction several years ago are now obsolete. They did it because of government policy, and I'll remain apolitical, but we can say that certain pieces of legislation like Bill C-48, Bill C-69 were not wonderful for the industry. And at the same time, the biggest challenge has been the lack of pipeline takeaway capacity, meaning we had too much production relative to pipe. We had to put barrels on rail, very expensive. And the differential for our product relative to global benchmarks ballooned out. Now that we've built line 3, it's online now. There's almost 300,000 barrels per day. There's a reversal of another pipeline. We've got TMX expansion Q1 of 2023. In short order, Canada is actually going to be overpiped, meaning the differentials will structurally be way, way, way tighter. And so with every dollar that we reduce the differential, it's like the oil price going up for these oil companies. So the ability for them to generate meaningful cash flow, and now in an environment of low to no growth, to maximize free cash flow and distribute that out to investors has never been better. And so my focus now is purely on Canada. And a key point that I want to make is even though certain funds, the index stocks have done pretty well, energy stocks today are cheaper than they were on January 1st of this year. And you might say, well, how is that possible? Like my fund's up about 160% year to date. Like, how is it possible that you can tell me with a straight face that stocks are cheaper today than they were on January 1st of this year? It's because so much of the performance year to date was repairing what happened from last year when stocks fell 90% in like 3 months. It was horrific. And so the catch up to even though an oil price in the 50s, it took some time. Now that we're using not even 85 where we sit, whereas right now I'm using $70 as my valuation threshold. If I can tell you with a straight face, I see very meaningful upside using 70, you're getting free call optionality on a higher oil price. And I can certainly profess that I see a meaningful opportunity in energy stocks, even using 70, which is $15 lower than where we are today. And yet, this was funny. So I mentioned I write this column for the Post, and on the same day that my column came out on the top, was talking about energy investors that miss out, et cetera. It was announced that the case to depose exiting. It was 1% of their assets. It was more psychology, but you are seeing divestments, ESG pressures impact the amount of capital available for these stocks. And so the question is, yes, stocks are cheap. It's $70 oil. The average name I follow is trading about 3 times cash flow, compares to the old multiples of 7 to 9. I think 4 to 6 is reasonable, which is about 10 to 15% target free cash flow yield, which is pretty good. At 80, we're sitting 85 now. The average company trading 2.5. And so, but what happens if the generalist doesn't come back? That's been a key concern of mine. And so, for a while now, I've been working with oil companies with 2 plans. My plan A is we're in a raging bull market. Oil is going to see all-time highs, and that will bring in capital, because as a fund manager, as an advisor, you can only underperform for so long until that fear of missing out and performance anxiety, where we can all be fired at the click of a mouse button. Eventually, you need to deploy capital, especially as stocks go up. With every headline of analysts talking about epic bull markets and super cycles and higher floors and all of these things, so just the pressure becomes too much. It's the inverse of what we felt March of April of last year when it was just so bad. And so that was my plan A. What if I'm wrong? I'm working on plan B, and B stands for buyback. And my main communication to these companies is forget growth. Nobody wants it, literally, anybody in the world. Maximize free cash flow, spend what you need to keep production flat, but maximize free cash flow and distribute at least half of that out to energy investors. And I run the largest energy fund in the country now, so that you can have a good conversation with CEOs, because we are the owners of the businesses. And so as we look at how much free cash flow can be distributed out, you can quickly see that many companies, even the large guys, could pay a dividend well in excess of 10%, using half of their free cash flow at $70 oil, which is a $15 discount to where we are today. And in fact, on the left-hand chart, this is one of the best charts I've ever done. This was meant to nullify the concern about, well, geez, Eric, this sounds great, and we like, your fund and whatever, but how do I tell a client to buy an energy stock, an energy fund, when I don't know what demand looks like 10 years from now, 15 years from now, et cetera? And so I wanted to create one tool that you could have to completely nullify that concern, and it's on the left. At $70 oil, again, $15 lower than where we are today, the average oil company cannot just become debt-free. They could buy back every single share outstanding with about 5 years of free cash flow. And so I don't care what oil looks like 15 years from now. I think, frankly, oil price is higher than where we are today. But barring that, what this tells you is you're getting free optionality on a rising oil price, higher than 70, frankly, and higher than 60. The average name, I think, is discounting a price in the high 50s. And you need not have believed a single word that I've just spent 37 minutes talking about. You need only believe in an oil price $15 lower than we are today, and stocks, in my opinion, represent a generational opportunity where we stand on the cusp of meaningful shareholder returns in the forms of buybacks and dividends. I think you'll start seeing that meaningfully with Q3 results, and especially with 2022 forecasts. And my fund, the Ninepoint Energy Fund, is extremely, in my opinion, well-positioned to benefit, not just from where I think we're headed, but where we already are. So I thank you very much for your time.